There is a force in the universe that Albert Einstein supposedly called the eighth wonder of the world. It's a force more powerful than armies, more transformative than any technology, and more reliable than any government. It operates silently, invisibly, in the background of our lives, governed by the immutable laws of mathematics. And yet, for all its power, most people will live their entire lives without ever truly harnessing it. They will feel its effects working against them in the form of credit card debt or loans, but they will never feel its incredible propulsive power working for them. This force is not a secret. It's not hidden in some arcane text or reserved for the financial elite. It is available to anyone with $1 and a day. It is the power of compounding. The man who has become synonymous with this force, who has used it to build a financial empire of staggering proportions from a handful of dollars in a small town in Nebraska, is Warren Buffett. And the story of his life is not a story of brilliant, high-risk trades or of divining the future. It is the story of a man who understood the eighth wonder of the world more profoundly than anyone else and had the discipline to let it work its magic, uninterrupted, for a lifetime. This is the antidote. It is the cure for the disease of impatience that plagues our modern world, a world that screams for instant results, for overnight success, for lottery ticket payoffs. Get-rich-quick schemes, frantic day trading, and speculative gambles are all symptoms of a fundamental misunderstanding of how real generational wealth is built. They prey on our most basic, flawed instincts, our desire to skip the process, to get the reward without the work, to compress a lifetime of value creation into a single explosive event. Warren Buffett's entire career is a testament to the opposite approach. It is a monument to the philosophy of getting rich slow. His core thesis, the genetic code of his success, is that the most powerful variable in finance is not genius, it is not timing, it is not even the amount of capital you start with. It is time. Uninterrupted time, applied to a quality asset, is a weapon of such immense power that it can turn a modest sum of money into a fortune that echoes for generations. 99% of Warren Buffett's net worth was earned after his 50th birthday. Let that sink in. For decades, he was simply laying the groundwork, building the base of a snowball that seemed, for the longest time, to be growing at an achingly slow pace. But as the decades rolled on, that snowball began to pick up mass and momentum, until it became an unstoppable avalanche of wealth. This is not a story about stock tips. This is a story about a fundamental law of the universe and how to align yourself with it. We are going to deconstruct, pillar by pillar, the operating system that allowed Warren Buffett to turn the simple principle of compound interest into the foundation of a financial fortress. We will explore not just the math but the psychology, the strategy, and the unshakable discipline required to truly use time as your ultimate ally. This is the final promise of patient capital. The first step on this journey is to move beyond a purely academic understanding of compounding. You may have seen the formula, you may have heard the term, but to truly wield it, you must internalize its logic. You must feel the slow, deceptive curve of exponential growth in your bones. This is Pillar 1, the unseen force, and it's about grasping the almost magical mathematics of how money begins to make its own money. Before Warren Buffett was the Oracle of Omaha, before he was a household name synonymous with wealth management and shrewd investing, he was a young boy in Nebraska with a voracious appetite for numbers and a mind that saw patterns others missed. His foundational encounter with the power of compounding didn't happen in a university lecture hall or on a Wall Street trading floor. It happened in the pages of a book he borrowed from the Benson Public Library. The book was titled 1,000 Ways to Make $1,000, and for most, it would have been a collection of quaint business ideas. For young Warren, it was a revelation. One chapter, in particular, seized his imagination. It described the concept of compound interest, illustrating how a small sum, if left to grow and reinvest its own earnings, could blossom into a significant fortune. The idea lodged itself deep in his mind. It wasn't just a financial trick. It was a law of nature. Like gravity, He began to see it everywhere. He calculated how long it would take for a small stake to grow into $1 million. He ran the numbers over and over, the exponential curve etching itself onto his psyche. He was only a child, but he had just discovered the blueprint for his entire life. But a concept is not a reality until it is applied. Buffett's first true business venture was a masterclass in this newfound understanding. It wasn't stocks or bonds. It was far more tangible. It was a pinball machine. At the age of 17, in 1947, Buffett partnered with his friend Don Danley. They saw an opportunity. Barbershops were places where men spent time waiting, and a little entertainment could be a profitable diversion. They pooled their money and bought a single used pinball machine for $25. They approached a local barber, a man named Frank Errico, and proposed a deal. They would place the machine in his shop, and they would split the profits 50-50. Mr. Errico agreed. Within hours, the machine started to work its magic. The clinking of nickels being dropped into the slot was the sound of their investment generating its first earnings. At the end of that first day, they opened the coin box and counted out their take. It wasn't a fortune, just a few dollars. And here is where the story diverges from the path most would take. A typical teenager might have taken his share of the profits and spent it on movies or comic books. This would have been a linear transaction: work, earn, spend. But Buffett's mind was already hardwired for compounding. He understood that the money in that coin box was not just a reward, it was a seed. It was fuel for the engine. He convinced Danley that they should not take any money out. Instead, they would plow every single nickel of their profit back into the business. Their mission was singular: to buy a second pinball machine. It took time. The daily take was small, and the goal of another $25 machine seemed distant. This is the early, flat part of the compounding curve, the part that tests your patience and resolve. But they stuck with it. Eventually, they had enough. They bought a second machine and placed it in another barbershop. Now they had two machines working for them, two streams of nickels flowing into their treasury. Their profits doubled. The time it took to save for the third machine was dramatically shorter than the time it took for the second. Then came the fourth and the fifth. Within a few months, this small partnership, Wilson's coin-operated machine company, had a small fleet of pinball machines scattered in barbershops across Omaha. Each machine was a worker, earning money that was then used to hire more workers. It was a perfect, self-sustaining, and accelerating system. This was not just a pinball business. It was a physical manifestation of compound interest. Start with a small principal, one machine. Generate a return, the daily profits, and reinvest 100% of that return to grow the principal base. The initial $25 investment had become a thriving enterprise, and by the time Buffett sold the business a year later, he walked away with over $1,200. He had taken a simple idea from a library book and turned it into a tangible money-generating machine, proving to himself at a young age that the mathematical certainty of compounding was not a theory, but a powerful, practical tool for building wealth. The reason this simple concept is so difficult for most people to execute lies deep within the architecture of the human brain. We are simply not built to think exponentially. This is the underlying psychological principle that holds most people back: the exponential growth bias. Our evolutionary history has conditioned us for linear thinking. For millennia, our survival depended on understanding simple cause and effect relationships. If you throw a spear twice as hard, it goes roughly twice as far. If you plant twice as many seeds, you get roughly twice the harvest. Our brains developed to project the future in a straight line, based on recent experience. This cognitive shortcut works perfectly well for most everyday tasks. But when applied to finance and investing, it becomes a catastrophic flaw. An exponential curve, the very heart of compounding, behaves in a way that feels deeply unnatural to us. In the beginning, it's almost flat. If you invest $10,000 and it earns 10%, after 1 year you have $11,000. After the second year, you have $12,100. After the third, 13,310. To the linear brain, this looks like a slow, boring, and predictable process. The growth is barely noticeable. This is the period of maximum psychological danger. An investor, conditioned by a world of instant gratification, looks at this slow progress and feels a sense of failure. They hear stories of people doubling their money in a hot stock, and their own steady, plodding progress feels inadequate. This feeling triggers a cascade of cognitive biases. Impatience sets in. The desire for action to do something to speed up the process becomes overwhelming. This is why people jump from one investment strategy to another, why they sell a solid, slow-growing asset to chase a speculative fad. They are abandoning the exponential curve just before it begins its dramatic upward sweep, all because their linear brain cannot perceive the explosive potential building beneath the surface. It cannot intuitively grasp that the majority of the gains in any compounding journey happen in the final stages. Think of it like this. If you could fold a standard piece of paper in half 42 times, its thickness would reach the moon. The first 10 folds create a thickness that is barely perceptible. Even after 20 folds, it's still manageable. The linear brain sees this and concludes the process is unremarkable. But the explosive, mind-bending growth happens in the last few folds, where the accumulated thickness begins to double at a staggering scale. Most investors give up during the first 10 folds, completely unaware that they are walking away from a journey that ends at the moon. Buffett's genius was in recognizing this cognitive flaw in others and in himself, and then building a psychological framework to override it. He understood that the early, boring years were not a sign of failure, but a necessary foundation for the explosive growth to come. He embraced the boredom, knowing that the real reward was not in the initial sprint, but in finishing the marathon. So how can we, in a world of endless distraction and calls for immediate action, train our linear brains to grasp this exponential truth? We need an applied mental model, a blueprint that can translate this abstract mathematical concept into a visceral, intuitive feeling. The first tool is one of the most elegant shortcuts in all of finance, the Rule of 72. This is a simple formula that allows you to estimate how many years it will take for an investment to double at a given annual rate of return. You simply divide the number 72 by your interest rate. For example, if your investment portfolio is expected to generate an average return of 10% per year, you divide 72 by 10. The answer is 7.2. It will take approximately 7.2 years for your money to double. If you can achieve a more modest 7%, the average historical return of the stock market after inflation, it will take just over 10 years to double. If you find a truly exceptional investment that compounds at 15%, your money will double in just under 5 years. Take a moment to run these numbers for yourself. This simple rule is a powerful tool for retirement planning and for setting realistic expectations. It transforms the vague idea of growth into a concrete timeline of doublings. It's the first step in calibrating your brain to the rhythm of compounding. But to truly feel it, we need something more. We need the doubling game. I want you to imagine I am offering you a choice. Option A is I give you $1 million, cash, right now. Option B is I give you a single penny today, and for the next 30 days, I will double it every day. A penny, then 2 cents, then 4, then 8, and so on. Most people, guided by their linear brain, would take the $1 million. A penny seems worthless. Let's play out the game. Day 1, you have 1 cent. Day 2, 2 cents. Day 5, a mere 16 cents. You'd be feeling pretty foolish. After 10 days, you have just $5.12. The person who took the $1 million is laughing. After 20 days, a full 2/3 of the way through the month, your total is still only $5,242. It feels like a colossal failure. Your linear brain is screaming that you made a terrible mistake. This is the moment most investors capitulate. They sell their asset, they change their strategy, they give up. But now let the magic begin. This is the steep part of the curve. On day 21, your 5,000 doubles to over 10,000. On day 25, you finally cross $167,000. On day 28, you finally pass the $1 million mark with $1.3 million. And in the final 2 days, the growth becomes truly astronomical. On day 29, it doubles to $2.7 million. And on the final day, day 30, your single penny has become $5,368,709. More than 5 times the safe option of $1 million. This thought experiment is the key. It allows you to feel the frustration of the early days and the mind-boggling acceleration of the later days. The overwhelming majority of the gain happens at the very end. Internalizing this model is crucial for anyone serious about long-term investing. It serves as a psychological anchor during the long, flat periods of the compounding journey, reminding you that the most powerful growth is the growth you cannot yet see. It is the core of a sound investment philosophy. To fully appreciate the wisdom of this path, we must examine its opposite. We must explore the antithesis, the path of the 99%, which can be best described as the lottery ticket mindset. This mindset is rooted in the same cognitive flaw, the inability to grasp exponential growth, but it manifests as a desperate attempt to find a shortcut. Instead of embracing the slow, steady curve of compounding, the lottery ticket investor seeks a single, vertical line. They are not looking for a process, they are looking for an event. This manifests in several ways. The most common is the obsession with hot stocks and speculative assets. They hear a story on the news about a company with a revolutionary new technology or a cryptocurrency that has soared 1,000%. They are seduced by the narrative, by the promise of quick, life-changing wealth. They pile in, often at the peak of the hype, with no understanding of the underlying business or its long-term prospects. Their investment is not based on a calculated assessment of value, but on the fear of missing out and a hope to catch lightning in a bottle. Another manifestation is the world of day trading. The day trader believes they can outsmart the market by making dozens of trades a day, skimming small profits that will add up to a fortune. They are glued to their screens, riding the emotional roller coaster of every price tick. They are not investing in businesses. They are betting on squiggles on a chart. This approach is the polar opposite of compounding. Instead of letting a business work for them over years, they are trying to force a return in minutes or hours, incurring massive stress and transaction costs in the process. The core error in the lottery ticket mindset is the belief that wealth is an event to be discovered, rather than a structure to be built. It's the financial equivalent of believing you can get in shape by taking a magic pill instead of through consistent exercise and nutrition. The consequences are almost always disastrous. The hot stock crashes back to earth, the cryptocurrency bubble pops, the day trader's small gains are wiped out by a few bad trades. This path is littered with financial ruin and emotional exhaustion, precisely because it works against the fundamental laws of wealth creation. It is an attempt to defy financial gravity, and gravity always wins. It's a siren song that promises a shortcut to financial freedom, but almost invariably leads to the rocks of financial despair. The difference between these two approaches is not merely philosophical. It has a profound and direct financial connection that can be seen clearly on a balance sheet. Let's quantify the impact with a simple tale of 2 snowballs, representing 2 investors. Both start on a snowy hill with a small, identical snowball of capital, $10,000. Snowball A belongs to an investor who understands compounding. They pack it tightly with a good, quality business, let's say an index fund that tracks the market, and they give it a gentle push. Their goal is to let it roll down the long hill of time for 40 years, aiming for a historical average return of 10% per year. They will not touch it. They will not interfere. Snowball B belongs to an impatient investor. They start with the same $10,000 and the same 10% return. However, they believe in taking profits along the way. At the end of each year, They decide to withdraw just 20% of their annual gains to use as a little extra passive income. It seems sensible, a small reward for their efforts. Let's watch them roll. After the first year, both snowballs have grown to $11,000. Investor A leaves it all. Investor B has a gain of $1,000 and withdraws $200, leaving them with $10,800. A small difference. After 10 years, Snowball A, the uninterrupted snowball, has grown to $25,937. Snowball B, with the small annual leakage, has grown to only $21,478. The gap is noticeable, but not yet life-changing. But now, the power of the exponential curve begins to take hold. After 20 years, Snowball A is worth $67,275. Snowball B is worth just $46,128. The gap has widened dramatically. After 30 years, Snowball A is a formidable $174,494. Snowball B is languishing at $99,645. And finally, at the end of the 40-year journey, Snowball A crosses the finish line as a massive boulder of wealth, worth $452,592. Snowball B, the victim of a seemingly innocuous $200 withdrawal in its first year, is worth a comparatively meager $215,391. Less than half. That small, sensible decision to skim a little off the top each year didn't just cost the investor the sum of the withdrawals, it cost them all the future earnings those withdrawals would have generated. They didn't just take a few snowflakes off the ball, they fundamentally altered its trajectory and momentum. This is the direct financial consequence of interrupting compound interest. It is a quiet, slow-motion catastrophe that plays out over decades, turning the promise of financial independence into a reality of mediocrity. Understanding this mathematical truth is the first pillar of building real, lasting wealth. Once you have internalized the mathematics of compounding, you are immediately confronted with the next and perhaps greatest challenge. The math is simple, but the execution is not. The primary obstacle to harnessing the power of compounding is not intellectual, it is emotional. Our own minds are the greatest enemy of our long-term financial success. This brings us to Pillar 2, the cultivation of extreme patience. It is the development of the psychological armor required to protect the compounding process from our own worst instincts for impulsive action. The world will constantly try to knock you off course, to convince you to interrupt the process. To succeed, you must build a fortress of temperament. There is no story that better illustrates this than Warren Buffett's masterstroke during one of American Express's darkest hours, the great salad oil scandal of 1963. American Express at the time was seen as a blue-chip, unshakable financial institution. Its primary business was not credit cards, but travelers' checks and warehousing. It was a symbol of trust and stability. But in November of 1963, that trust was shattered. A small company in New Jersey called Allied Crude Vegetable Oil, run by a charismatic fraudster named Tino DeAngelis, had perpetrated a massive scam. Allied had taken out huge loans from various Wall Street firms, secured by its inventory of salad oil, which was stored in giant tanks. American Express, through its warehousing subsidiary, had issued receipts certifying the existence of this oil. The problem was, the oil didn't exist. The tanks were mostly filled with seawater, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude collapsed, defaulting on $175 million in loans, a colossal sum at the time. Since American Express had certified the collateral, Wall Street panicked. The assumption was that Amex would be on the hook for all of Allied's bad debts, a liability that would wipe out the company entirely. The stock plummeted. In a matter of weeks, American Express stock was cut in half, falling from over $60 a share to $35. Fear gripped the market. The story was simple and terrifying. American Express was bankrupt. Everyone was selling. This is the moment where most investors, even professional ones, would have run for the hills. The news was terrible, the uncertainty was total, and the herd was stampeding for the exit. But Warren Buffett did something different. He did not react to the price. He reacted to the facts. He calmly set out to answer a single question. Was the underlying, fundamental business of American Express still intact? He didn't rely on newspaper headlines or Wall Street gossip. He conducted his own, on-the-ground investigation. He went to restaurants and travel agencies. He visited banks. He talked to merchants. He observed customers. He was looking for evidence of the brand's true strength. Was the scandal causing people to stop using American Express travelers' checks? Were merchants refusing to accept their cards? The evidence he gathered was overwhelming. He saw that customers and businesses still trusted the American Express brand. The scandal was related to a peripheral warehousing division. The core financial products that people used and relied on every day were unaffected. The fear was a phantom. Convinced that the market's panic was a wild overreaction, Buffett acted decisively. He committed 40% of his investment partnership's capital, a massive bet, to buying shares of American Express. It was the single largest investment he had ever made. And then, after this moment of decisive action, came the most important part. He waited. He had the extreme patience to sit and do nothing while the market slowly, grudgingly, came around to his point of view. It took time, but eventually, the fear subsided, the company's resilience became clear, and the stock price recovered and then soared. Within a few years, Buffett's partnership had made a $20 million profit on its $13 million investment. This story is a perfect illustration of the psychological armor required for successful long-term investing. It is the ability to remain rational when others are fearful, to act on diligent research rather than emotion, and critically, to have the patience to allow your thesis to play out, even when the world is screaming that you are wrong. The intense psychological pressure that Buffett overcame in the salad oil scandal is a product of powerful cognitive biases that are deeply ingrained in our mental hardware. The most potent of these is loss aversion. Decades of research by psychologists like Daniel Kahneman and Amos Tversky have shown that, for the human brain, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. This simple asymmetry has profound implications for an investor's behavior. When the market is falling, as it was for American Express, each downward tick of the stock price triggers a powerful, visceral pain response. Our natural instinct is to make the pain stop. The easiest way to do that is to sell the asset. The moment you sell, the pain of watching it fall further is gone, replaced by a sense of relief. This is why so many investors panic and sell at the bottom of a market crash. They are not making a rational financial decision. They are making an emotional decision to stop a perceived psychological torment. This act of selling in a panic is the cardinal sin against compounding. It is the forced interruption of the process at the worst possible moment, locking in losses and ensuring you miss the eventual recovery. A related and even more insidious bias in our modern age is myopic loss aversion. This is the tendency to feel the pain of loss more acutely when you check the value of your investments frequently. In Buffett's day, you might have gotten a stock quote once a day from the newspaper. Today, we have apps on our phones that give us real-time, second-by-second updates. Every flicker of red on the screen is a small dose of psychological pain. Checking your portfolio multiple times a day is like exposing yourself to a continuous stream of these painful stimuli. This constant monitoring magnifies the effects of loss aversion, dramatically increasing the likelihood that you will react emotionally to short-term market noise. You become hyper-focused on the daily volatility and lose sight of the long-term trend. The financial media and brokerage industry are, in a sense, designed to exploit this psychological weakness. A constant stream of breaking news, price alerts, and expert predictions creates a sense of urgency and a need to be constantly engaged. This environment encourages tinkering, trading, and reacting, all behaviors that are fundamentally hostile to the patient, long-term process of compounding. Building the psychological armor that Buffett possesses means consciously recognizing and fighting these biases. It requires developing the discipline to zoom out, to ignore the daily noise, and to focus on the decades-long journey, not the minute-by-minute fluctuations. So how can an ordinary person susceptible to these powerful biases develop this kind of psychological fortitude? We need an applied mental model, a practical blueprint for building patience and discipline into our investment process. The first part of this blueprint is the 10-year test. Before you make any investment, whether it's buying a single stock or an index fund, you must subject it to this test. You take out a piece of paper or open a document, and you write down, in your own words, a clear and simple thesis for why you are making this investment. Then, you must answer this question honestly. Am I willing to hold this asset for a minimum of 10 years? And then, the crucial follow-up. Would I still be comfortable holding this asset if its market price were to fall by 50% tomorrow, and the financial news was uniformly negative about its prospects? This exercise does two things. First, it forces you to move beyond short-term speculation and think like a long-term business owner. If you can't articulate a reason to own something for a decade, you probably shouldn't own it for 10 minutes. Second, it acts as a psychological pre-commitment. By mentally rehearsing a worst-case scenario, you inoculate yourself against future panic. When a market crash inevitably happens, you won't be caught off guard. You will have already decided, in a calm and rational state of mind, that volatility is part of the journey and that your plan is to hold through it. The second part of the blueprint is the automation shield. The single best way to protect yourself from your own emotional decision-making is to remove the decisions altogether. Set up a system of automatic recurring investments into your chosen assets. This could be a monthly transfer from your checking account into a retirement account that buys an S&P 500 index fund. The amount doesn't have to be large. The key is the consistency and the automation. This strategy, often called dollar-cost averaging, accomplishes a critical psychological goal. It separates the act of investing from the emotional state of the market. You are buying on a schedule, not based on feeling. When the market is high, your automatic investment buys fewer shares. When the market is low and fear is rampant, your automatic investment becomes a courageous act of buying low, executed by a robot that feels no fear. This system builds your wealth in the background, harnessing the power of compounding without requiring you to constantly overcome your own worst instincts. It is a core strategy for personal finance for beginners and seasoned investors alike, building a shield against the behavioral traps that derail most investment plans. To truly understand the power of this disciplined, patient approach, we need to examine its antithesis, the behavior of the frenetic tinkerer. This is the profile of the vast majority of individual investors. The frenetic tinkerer treats their investment portfolio not as a garden to be patiently cultivated, but as a complex machine that requires constant adjustment and optimization. They are perpetually logged into their brokerage account, watching the real-time profit and loss figures dance across the screen. They subscribe to newsletters, watch financial news channels, and read countless articles, all in an effort to find an edge, to get ahead of the next market move. This constant influx of information, combined with the psychological biases of loss aversion and the need for action, creates a disastrous feedback loop. When a stock they own goes up, they feel the urge to sell it and, quote, lock in the gain, cutting off a potential long-term compounder at the knees. When a stock goes down, they hold on, hoping it will come back to what they paid for it, a bias known as anchoring. Or, if the fear becomes too great, they sell it at the bottom, crystallizing their loss. They engage in performance chasing, selling the assets that performed poorly last year to buy the assets that performed well, ensuring they are always buying high and selling low. They are like a nervous gardener who can't resist digging up their carrots every day to see if they are growing. The result of all this activity is not superior performance, but a portfolio ravaged by poor timing and self-inflicted wounds. The frenetic tinkerer believes they are being a diligent and engaged financial advisor to themselves, but in reality they are their own worst enemy. Their constant tinkering prevents any of their assets from having the uninterrupted time needed to compound effectively. Every trade, every change, every reaction to the news resets the clock. They are perpetually stuck in the flat, early part of the exponential curve, never allowing themselves to experience the explosive growth that comes with years of inactivity. They mistake activity for progress, and in doing so they sabotage their own journey to financial independence. The financial cost of this impatience and frenetic activity is not just theoretical, it manifests directly and devastatingly on an investor's balance sheet through two primary channels, the tax drag and the friction fallacy. Let's start with the tax drag. In the United States, when you sell an investment that has gone up in value, you are required to pay capital gains tax on the profit. This is a direct, tangible cost that is triggered only by the act of selling. Let's imagine two investors, Patient Pete and Active Adam. Both invest $100,000 into a stock that grows at a healthy 10% per year for 30 years. Patient Pete follows the Buffett model. He buys the stock and does absolutely nothing. He lets it ride for the full 30 years. At the end of the period, his initial $100,000 has compounded into $1,744,940. He decides to sell it all to fund his retirement. His profit is over $1.6 million. He pays a long-term capital gains tax on this profit, let's say at a rate of 20%. His tax bill is roughly $328,000. Leaving him with a net worth of over $1.4 million. Now consider Active Adam. He owns the exact same stock, achieving the exact same 10% annual return. However, Adam is a tinkerer. At the end of every single year, he sells the stock to lock in his gain, and then immediately buys it back. He thinks he is being clever, but each time he sells, he triggers a tax event. In year 1, his $100,000 grows to $110,000. He sells, pays 20% tax on his $10,000 gain, $2,000, and reinvests the remaining $108,000. He starts year 2 with less capital than Pete. This process repeats, year after year. The taxman takes a small bite out of his profits annually. At the end of the 30-year period, Active Adam's final net worth is not $1.4 million. It is only $995,000. He has lost over $400,000, nearly a third of his potential wealth, not because he chose a bad investment, but simply because of his impatience. He voluntarily gave away a fortune to the government, year by year. This is the tax drag. The second cost is the friction fallacy. The tinkerer believes that trading is free or cheap, but every transaction has hidden costs. There is the bid-ask spread, the small difference between the price you can buy a stock for and the price you can sell it for. There may be commissions. These small frictional costs act like a constant headwind, slowing down the portfolio's growth. The patient, buy-and-hold investor avoids these costs almost entirely. Their inactivity is a direct financial advantage. It keeps their capital fully invested and working for them, preventing the leakage that slowly but surely drains the wealth of the impatient. Patience is not just a virtue, it is a quantifiable financial asset. Once an investor has grasped the mathematics of compounding and cultivated the psychological patience to let it work, they face a critical, practical question. What exactly should they be compounding? The exponential engine is powerful, but it needs the right fuel. Throwing time at a low-quality asset is like trying to grow a mighty oak from a dead acorn. It will not work. The magic of compounding can only be unlocked when it is applied to a specific type of asset, a true compounding machine. This brings us to Pillar 3, the compounding machine, and the art of selecting businesses that are built for the long haul. This is where Buffett's investment philosophy evolved from its early, quantitative roots into a search for qualitative excellence. The quintessential story of this evolution, and the perfect example of a compounding machine, is Buffett's purchase of See's Candies in 1972. At this point in his career, Buffett was still heavily influenced by his mentor, Benjamin Graham, the father of value investing. Graham's approach was often described as cigar butt investing, looking for discarded, statistically cheap companies that had one last, free puff of profit left in them. You'd buy them, wait for the market to realize they were worth a little more than their bargain basement price, and then sell. It was profitable, but it wasn't scalable, and it didn't harness the true, long-term power of compounding. It was Charlie Munger, Buffett's brilliant partner, who pushed him to evolve. Munger argued that it was far better to buy a wonderful business at a fair price than a fair business at a wonderful price. See's Candies was the first major test of this new philosophy. By all of Buffett's old metrics, See's was expensive. He and Munger were looking to buy the company for $25 million, which was a significant premium over its book value. Buffett was hesitant. His cigar butt brain was screaming that it was too expensive. Munger persisted, convincing him to look beyond the simple numbers and at the quality of the business itself. And what a business it was! See's Candies had an array of characteristics that made it a near-perfect compounding machine. First, it had an incredibly powerful brand and deep customer loyalty, forged over decades. In California, giving a box of See's Candies on Valentine's Day or Christmas was a tradition. This brand loyalty gave See's enormous pricing power. Every year, they could raise the price of their chocolates a little bit, and customers would happily pay because the product was associated with happy memories and quality. This ability to raise prices without losing business is a hallmark of a great company. Second, the business required very little capital to grow. They didn't need to build massive, expensive factories or spend billions on research and development. Their growth was organic and funded by their own profits. Finally, because of these factors, See's gushed cash. It produced far more money than it needed to maintain its operations. This free cash flow was the golden egg. Buffett and Munger bought the company for $25 million. That initial investment has since returned over $2 billion in profits to Berkshire Hathaway, profits that did not need to be reinvested back into the candy business. This torrent of cash from See's was then used by Buffett to buy other businesses, fueling Berkshire's growth for decades. See's Candies became the prototype for the Buffett-Munger investment philosophy. Find a business with a durable competitive advantage, one that earns high returns on the capital it employs, buy it at a reasonable price, and then let it generate cash for you for the rest of your life. It was a profound shift from finding temporary bargains to acquiring permanent quality. The reason most investors fail to identify and invest in wonderful businesses like See's Candies lies in a pair of powerful psychological biases: the availability heuristic and what we can call brand blindness. The availability heuristic is a mental shortcut our brains use, where we judge the likelihood of an event by how easily examples of it come to mind. In the world of investing, this means we are naturally drawn to companies that are constantly in the news, that have exciting, complex stories, and that everyone is talking about. These are the available ideas. Think of the hot technology stocks, the biotech companies promising a cure for a major disease, or the electric vehicle makers with visionary CEOs. Their stories are compelling, accessible, and endlessly discussed on financial television. This makes them seem like the most obvious and attractive investment opportunities. In contrast, a company like See's Candies is, for lack of a better word, boring. Its business model is simple: make good chocolate, sell it for more than it costs to produce. It doesn't generate dramatic headlines. Its CEO is not a media superstar. Because its story is less available, our brains tend to underestimate its value and overlook it as a serious investment. This leads to brand blindness. We see brands like Coca-Cola, See's Candies, or Wrigley's gum every day. We interact with them, we understand them, but we fail to see the powerful economic engine that lies behind the familiar logo. We mistake simplicity for a lack of sophistication. The average investor is on a quest for the next big thing, the complex technology they barely understand, because they believe that is where the big money is made. They are blind to the incredible wealth-generating power of a simple, durable brand that has woven itself into the fabric of society. Buffett's genius is his ability to invert this. He actively seeks out the simple, the understandable, and the boring. He knows that a business that has been selling the same product for 50 years and will likely be selling it for 50 more has a predictability and durability that a high-tech startup can only dream of. His investment philosophy is a conscious effort to override the siren song of the available and exciting, and instead focus on the quiet, consistent hum of a truly great, and often simple, business. This is a crucial part of his investment strategy and a key to long-term financial education. How can we, as individual investors, learn to spot these high-quality compounding machines? We need a practical tool, an applied mental model that can help us cut through the noise and identify businesses with enduring strength. The best tool for this is the Durable Competitive Advantage Checklist. A durable competitive advantage, what Buffett calls a moat, is a structural feature of a business that protects it from competitors, allowing it to earn high profits for a very long time. Before investing in any company for the long term, you should be able to check at least one of these boxes. Let's walk through the checklist. First, does the business have a powerful brand or a government-protected patent? Think of Coca-Cola. The brand itself is a promise of a specific taste and quality that is recognized globally. A competitor can make a brown, sugary, carbonated beverage, but they cannot call it Coke. This brand power allows Coca-Cola to charge a premium and maintain its market share. This is a toll bridge for the mind. Second, does the business benefit from high switching costs for its customers? This means it is difficult, expensive, or a major hassle for a customer to move to a competitor. A classic example is Microsoft Windows. An entire organization builds its workflow, trains its employees, and buys compatible software based on the Windows operating system. The cost and disruption of switching to a different system, even if it were slightly better, would be enormous. This locks customers in and gives Microsoft immense pricing power. Third, does the business benefit from a network effect? This is when a product or service becomes more valuable as more people use it. Think of a social media platform like Facebook, or a payment system like Visa. A credit card is only useful if many merchants accept it, and merchants will only accept it if many customers have it. This creates a powerful, self-reinforcing loop that makes it incredibly difficult for a new competitor to break in. Fourth, does the business have a significant low-cost advantage? Can it produce its product or service cheaper than anyone else, allowing it to either undercut competitors on price or enjoy fatter profit margins? Think of a company like Costco or Walmart, whose immense scale allows them to negotiate lower prices from suppliers than any smaller retailer could hope for. This checklist is not exhaustive, but it provides a powerful framework. When you are analyzing a potential investment, don't just look at the stock price. Ask these questions. Try to identify the moat. If you can't find one, it doesn't matter how exciting the story is. The business is likely a poor candidate for long-term compounding because, without a moat, competition will eventually erode its profits. This is the foundation of a sound investment philosophy. The antithesis to this disciplined search for quality is one of the most common and dangerous traps in investing, the story stock trap. A story stock is a company that has a captivating narrative but weak or non-existent underlying business fundamentals. These are companies that are often pre-revenue or pre-profit, but they have a grand vision of changing the world. Investors fall in love with the story, not the business. The narrative might be about a new technology that will revolutionize an industry, a miracle drug that will cure a disease, or a new social media app that will connect humanity in a new way. The story creates a powerful sense of hope and excitement, and the stock price can soar based on this enthusiasm alone. The problem is that a great story is not a substitute for a great business. Most of these visionary companies will fail. They will run out of money before their product finds a market, their technology will be surpassed by a competitor, or their miracle drug will fail its clinical trials. The investor who buys a story stock is not investing in a proven, cash-generating machine like See's Candies. They are making a highly speculative bet on a low-probability outcome. They are buying a lottery ticket with a great marketing campaign. Buffett has famously avoided technology stocks for much of his career, not because he is against technology, but because he often finds it difficult to identify durable competitive advantages in rapidly changing industries. He prefers the certainty of a company that sells chewing gum to the uncertainty of a company trying to invent a new form of artificial intelligence. The story stock investor does the opposite. They are drawn to the uncertainty and the massive potential payoff, ignoring the high probability of a total loss. They confuse a compelling vision with a sustainable business model. This trap preys on our love of narratives and our desire for explosive growth, but it often leads to a portfolio filled with exciting ideas and devastating financial losses. It is the rejection of the proven reality of a compounding machine in favor of the speculative dream of a rocket ship that is just as likely to explode on the launch pad. The difference between a true compounding machine and a story stock can be measured and seen directly in a company's financial statements. The key metric, the number that quantifies the horsepower of the compounding engine, is return on invested capital, or ROIC. While that may sound complex, the concept is simple and vital for anyone wanting to achieve financial independence. Imagine a company as a gumball machine. The money the company uses to run and grow its business, its factories, its inventory, its technology, is the capital invested in the machine. ROIC tells you how many gumballs of profit the machine spits out each year for every dollar of capital put into it. A company with a 20% ROIC is generating 20 cents of annual profit for every dollar it has invested in its operations. A high and consistent ROIC is the mathematical signature of a great business with a strong moat. Let's compare two businesses. Company A is a software company with a powerful brand and high switching costs. It has an ROIC of 25%. Company B is a capital-intensive airline. It has to spend enormous sums on airplanes, fuel, and labor, and it operates in a fiercely competitive industry. Its ROIC is a mere 5%. Both companies earn $100 million in profit this year. Both decide to reinvest all of that profit back into their business. Company A, with its 25% ROIC, will turn that $100 million reinvestment into an additional $25 million of profit next year. Company B, with its 5% ROIC, will only generate an additional $5 million of profit from the same reinvestment. Company A can grow its earnings power 5 times faster than Company B, without needing any outside money. It is a self-funding, high-speed compounding machine. Company B is slogging through mud, requiring massive amounts of capital just to achieve meager growth. Over a decade, the difference in their intrinsic value will be astronomical. This is the direct financial connection. A high ROIC is the fuel for exponential growth. When you buy a company with a high and durable ROIC, you are buying a business that can compound your capital internally at a high rate, year after year. This is the financial engine that powers the journey from a small snowball of capital into a massive fortune. We have now established the mathematical foundation of compounding, the psychological discipline required to stick with it, and the criteria for selecting the right kind of assets to compound. This brings us to the fourth and perhaps most deceptively simple pillar of the Buffett philosophy. It is a pillar built not on action, but on its opposite. It is the radical idea that after you have done the initial hard work of research and selection, the most profitable and intelligent thing you can do is often nothing at all. This is Pillar 4, the sin of interruption. It is the recognition that hyperactivity is the enemy of returns, and that true investment genius is often expressed through prolonged periods of calculated inactivity. It's about letting the powerful engine you've chosen do its work without your constant interference. No story in Warren Buffett's career embodies this principle more perfectly than his investment in the Washington Post. In 1973, the stock market was in a deep gloom. The Nifty 50 bubble had burst, and sentiment was abysmal. The Washington Post company, despite being a premier newspaper with a powerful franchise, was caught in the downdraft. Its stock was trading for a fraction of what Buffett calculated the business was intrinsically worth. He saw a wonderful business on the sale rack. So he started buying, quietly and patiently. Over several months, Berkshire Hathaway invested about $10.6 million to acquire a significant stake in the company. He had found his compounding machine and he had bought it at a fair price, and then, for the next 3 decades, he performed his greatest magic trick. He did nothing. He just held. Think of everything that happened over the next 30-plus years. There was the stagflation of the late 1970s, the brutal recession of the early 1980s, the stock market crash of 1987, when the Dow Jones fell over 22% in a single day, the dot-com bubble and its subsequent bust in 2000, the rise of the internet, which many believed would be the death of newspapers. Through all of this turmoil, all of this noise, all of the calls to sell, Buffett remained completely inactive with his Washington Post shares. He had made his decision based on the long-term value of the business, and he was not going to let short-term market sentiment or economic forecast shake him from his position. He treated his stock certificate not as a flickering quote on a screen, but as a deed of ownership in a superior business run by people he trusted, namely Katharine Graham. He let the business compound its value, year after year, decade after decade. That initial $10.6 million investment, through stock splits and the company's own growth, blossomed into a holding worth over $1 billion. It was a 100-fold return, a testament to the staggering power of combining a great business with an uninterrupted multi-decade time horizon. The genius was not in the initial purchase, brilliant as it was. The true genius was in the 30 years of doing nothing, of resisting the temptation to trade, to take profits, or to panic. It was the ultimate demonstration that time in the market, not timing the market, is where real wealth is built. The deep-seated human instinct that makes such profound inactivity so difficult to achieve is known as action bias. This is the cognitive tendency to favor action over inaction, even when inaction is the more rational course. In situations of ambiguity, uncertainty, or fear, our brains are wired with a powerful impulse to do something. Our ancestors on the savannah who heard a rustle in the grass and immediately ran were more likely to survive than those who sat and calmly analyzed the situation. Action was survival. In the modern world of investing, however, this same instinct is often a recipe for disaster. When the market crashes and our portfolio is bleeding red, the action bias screams at us, "Sell! Protect what's left! Do something!" The feeling of just sitting there and watching your net worth decline is intensely uncomfortable. Selling provides a sense of agency, a feeling of taking control, even if it is the precisely wrong thing to do. Conversely, when the market is euphoric and everyone around you seems to be getting rich, the action bias, fueled by greed and the fear of missing out, screams, "Buy! Don't get left behind! Do something!" This leads to piling into assets at the peak of a bubble. Warren Buffett's superpower is his almost complete immunity to action bias. He has cultivated the temperament to be comfortable with inaction. He famously said that an investor should be given a punch card with only 20 punches on it for their entire lifetime. Each time they make an investment decision, they use up a punch. This mental model forces an investor to think incredibly carefully before acting, to reserve their actions for only the most compelling, no-brainer opportunities. For Buffett, activity is a sign of weakness, an admission that you don't have confidence in your original decisions. He understands that the stock market is a device for transferring money from the active to the patient. His career is a monument to the idea that great results in investing do not come from a flurry of brilliant moves, but from a handful of good decisions, followed by a lifetime of disciplined waiting. Overriding the deep-seated urge to act is one of the most difficult and most profitable skills an investor can learn. So how can we, who are constantly bombarded with calls to action, develop this skill of strategic inactivity? We need an applied mental model, a practical system for protecting our portfolio from our own worst impulses. This system is the Portfolio Hibernation Plan. It's a 3-step process to enforce discipline and short-circuit the action bias. Step 1 is to define your do-nothing period. At the beginning of each year, make a conscious written commitment to yourself that you will not make any non-automated portfolio changes for a set period. This could be 6 months, or preferably a full year. The only exception is for your regular, pre-scheduled contributions. This act of pre-commitment in a calm state makes it much harder to break your own rules when you are in an emotional state later. Step 2 is to create an impulse journal. Keep a notebook or a document specifically for this purpose. Whenever you feel the powerful urge to make a trade, to sell a falling stock or buy a soaring one, you are not allowed to act on it immediately. Instead, you must first open your journal and write down 3 things: the date, the specific action you want to take, and the primary emotion that is driving this desire, e.g., fear, greed, anxiety, boredom. Then, you must write a short paragraph explaining your rational thesis for the trade. This simple process acts as a crucial cooling-off period. It forces you to translate a raw emotion into a reasoned argument. More often than not, the urge will pass once you see it written down. Reviewing this journal every few months is also incredibly instructive. You will begin to see patterns in your emotional triggers and realize how many of your high-intensity impulses would have turned out to be terrible financial decisions. Step 3 is to go on an information diet. The action bias is triggered by external stimuli. The more you consume, the more you will want to act. You must curate your information environment to promote long-term thinking. Delete the stock market app from your phone's home screen. Unfollow the financial news pundits on social media who are paid to generate excitement and urgency. Stop watching the market's daily gyrations. Check your portfolio on a schedule, once a month, or even once a quarter, rather than reactively. By reducing the volume and velocity of the inputs, you dramatically reduce the emotional noise that leads to bad decisions. The portfolio hibernation plan is a system for building an environment where patience is the default setting, allowing your well-chosen assets the uninterrupted time they need to work their compounding magic. The destructive nature of hyperactivity becomes even clearer when we examine its antithesis, the common behaviors of performance chasing and market timing. This is the path taken by the vast majority of active investors, and it is a guaranteed route to underperformance. Performance chasing is the habit of constantly rotating your portfolio based on recent past performance. An investor looks at their holdings at the end of the year. They see that technology stocks did great, while healthcare stocks did poorly. So they sell their healthcare stocks, selling low, and use the money to buy more technology stocks, buying high. They are essentially driving by looking only in the rearview mirror. The problem is that market leadership rotates. The next year, technology might underperform while healthcare rebounds, and the investor will be caught on the wrong side of the trade yet again. They are in a perpetual cycle of being one step behind the market. Market timing is an even more arrogant form of hyperactivity. The market timer believes they can predict the short-term movements of the market. They try to sell their stocks just before a crash and then buy them back at the absolute bottom. While this sounds wonderful in theory, there is no evidence that anyone can do this successfully and consistently. To be a successful market timer, you have to be right twice. You have to get out at the right time, and you have to get back in at the right time. Missing the timing on either end can be catastrophic. Data from market research firm Dalbar consistently shows that the average individual investor dramatically underperforms the market itself, and the primary reason is a series of poorly timed buy and sell decisions. Consider this staggering statistic. Over a 20-year period, if an investor in the S&P 500 simply stayed fully invested, their returns would be significant. But if they tried to time the market and missed just the 10 single best trading days over that entire 2-decade span, their total return would be cut in half. Miss the 20 best days and their returns are almost completely wiped out. The market's biggest gains often come in short, explosive bursts, usually immediately following periods of intense fear. The very people who sell in a panic are the ones who are guaranteed to miss the best days of the recovery. This is the ultimate folly of the active approach. In an attempt to be clever and avoid the downturns, the hyperactive investor almost invariably ends up avoiding the massive upturns that generate the majority of long-term wealth. The direct financial connection here is not just about missing out on gains, it's also about the slow, steady drain of capital caused by what can be called compounding leakage. Every act of trading creates small, often invisible, costs that act as a drag on your portfolio's growth. When these costs are repeated over and over, they create a massive wealth gap over time. Let's quantify this. Imagine an inactive, low-cost index fund investor. They buy their fund and hold it for 30 years. Their only significant cost is the fund's expense ratio, which for a good index fund might be as low as 0.04% per year. It's almost nothing. Now consider an active trader or someone invested in an expensive, actively managed mutual fund. First, there are the explicit costs. The active mutual fund might charge an expense ratio of 1% per year. That might not sound like much, but over 30 years, that 1% fee can consume nearly a third of the investor's potential final nest egg. If the investor is trading individual stocks, they face commissions and, more insidiously, the bid-ask spread on every single trade. This spread is a hidden transaction tax that shaves a little bit of value off every time you buy and sell. Second, and more significant, are the tax costs we discussed earlier. The inactive investor defers capital gains taxes for decades, allowing the full, pre-tax amount of their capital to compound. The active trader triggers tax events constantly, pulling money out of their compounding engine to pay the government every year. When you combine these leaks, higher fees, trading costs, and tax inefficiency, the impact is devastating. Let's run the numbers on two investors starting with $100,000, both achieving a pre-fee, pre-tax return of 10% for 30 years. The inactive index investor, with minimal fees and no tax drag, ends up with over $1.6 million after tax. The active investor, leaking just 2% of their assets per year to a combination of higher fees and tax inefficiency, ends up with just $900,000. They have performed the same in the market, but their behavior, their hyperactivity, has cost them over $700,000. This is the direct, quantifiable financial power of inactivity. It's not just about avoiding mistakes. It's about plugging the leaks and ensuring that your compounding machine is operating at its maximum possible efficiency, with as little friction as possible. We have arrived at the final pillar, the one that ties all the others together and represents, perhaps, Warren Buffett's single greatest and most misunderstood advantage. It is the concept that elevates his entire strategy from a mere investment technique to a profound philosophy of business and life. Having understood the math, cultivated the patience, selected the right machine, and committed to inactivity, you must now wield the ultimate weapon. This is Pillar 5, the time horizon arbitrage. It is the practice of weaponizing decades in a world that is pathologically obsessed with quarters. It is the recognition that in the frantic, short-term oriented world of modern finance, a truly long-term perspective is the rarest and most valuable commodity of all. The ultimate foundational anecdote for this pillar is not a single investment, but the very structure of Berkshire Hathaway itself. To understand Buffett's genius, you must understand that he didn't just apply a long-term philosophy, nuclear within the conventional system. He built an entirely new system, designed from the ground up to facilitate and reward a long-term perspective. Unlike a typical mutual fund or a private equity fund, Berkshire Hathaway is a permanent capital vehicle. Let's deconstruct what this means. If you manage a mutual fund, your investors can pull their money out at any time. If the market crashes and your investors panic, they will redeem their shares, forcing you to sell your stocks at the worst possible moment to meet those redemptions. Your time horizon is effectively dictated by the emotional state of your most fearful investor. A private equity fund is slightly better, typically locking up investor capital for 5 to 10 years. But even they are on a clock, forced to buy and sell companies within a defined period to generate returns for their limited partners. Buffett saw this structural flaw, the flaw of temporary capital, and he engineered a solution. Berkshire Hathaway is a corporation, not a fund. When you buy a share of Berkshire, you cannot call Buffett and ask for your money back. You can only sell your share to another investor in the open market. This means the capital inside Berkshire Hathaway is permanent. It is locked in. This seemingly simple structural difference is the source of Buffett's greatest power. It gives him an almost infinite time horizon. He can make investments today that may not pay off for 10, 20, or even 30 years without ever facing a redemption call from a nervous investor. It allows him to be truly greedy when others are fearful, using his permanent capital base to buy assets at bargain prices during market panics when other fund managers are being forced to sell. Look at his massive investments in capital-intensive industries like railroads, Burlington Northern Santa Fe, or energy, Berkshire Hathaway Energy. These are businesses that require immense, long-term capital commitments to build infrastructure that will generate cash flow for a century. No typical fund manager with their quarterly performance reviews could ever justify such a patient, generational investment. Buffett can, because his system is built for it. Berkshire Hathaway is not just a collection of businesses, it is a machine designed to arbitrage time. It exploits the structural short-sightedness of the entire financial industry, turning the market's obsession with the next 90 days into his single greatest competitive advantage. The psychological principle that creates this massive market inefficiency that Buffett so brilliantly exploits is called hyperbolic discounting. This is a cognitive bias that describes our tendency to have a stronger preference for more immediate payoffs over later payoffs. The further a reward is in the future, the more we discount its value in our minds. For example, most people would prefer to receive $100 today rather than $105 in a week. The immediate gratification of the $100 feels more valuable than the larger, delayed reward. This bias is hardwired into our brains. For most of human history, the future was deeply uncertain. It was more rational to take the food that was available today than to wait for a larger but less certain meal tomorrow. In the modern financial world, this deeply ingrained instinct for immediate gratification creates a systemic and pervasive short-term focus. The entire ecosystem of Wall Street is built around hyperbolic discounting. Corporate CEOs are given bonuses based on quarterly earnings per share and short-term stock performance. This incentivizes them to make decisions that will boost the stock price now, even if it means sacrificing long-term value. They might cut research and development budgets or postpone necessary but expensive infrastructure upgrades just to make the quarter. Wall Street analysts then issue buy and sell ratings based on whether a company beats or misses these quarterly estimates by a penny. The financial media, in turn, amplifies this short-term noise, creating a frenzy of activity around these 90-day data points. This creates a market where the vast majority of participants are playing a completely different game than Buffett. They are playing a 90-day sprint. He is playing a 50-year marathon. Hyperbolic discounting causes them to systematically undervalue the long-term future. They overvalue the immediate, certain reward of a good quarter and drastically undervalue the larger, less certain reward of a business's value in a decade. Buffett's entire philosophy is a conscious and rational rebellion against this bias. By training his mind to value the distant future appropriately, he can see value where others see only uncertainty. He is able to buy the promise of a great harvest in 10 years for a fraction of its true worth, because everyone else is focused on how much grain they can get in the next 10 days. How can we, as individuals operating in this short-term world, learn to adopt this powerful long-term mindset? We need an applied mental model to force this shift in perspective. That model is the generational ledger. This is a simple but profound thought exercise that you can apply to any major financial or life decision. Take out a sheet of paper and draw 2 columns. On the left side, write down the decision you are contemplating. This could be anything from selling my investment in company X because it's down 20%, to taking a higher-paying but more stressful job, or buying a new expensive car on credit. Now, in the right-hand column, you are going to analyze the long-term consequences of this decision through two specific lenses. First, write down the likely impact of this decision on your 20 years in the future self. Be specific and honest. For the decision to sell the stock, the entry might be, "My future self will have locked in a permanent loss and will have missed out on the probable long-term recovery and compounding of a good business, significantly reducing the size of my retirement nest egg." For the decision to buy the expensive car, it might be, "My future self will have spent years making payments on a depreciating asset, money that could have been invested and grown into a substantial sum, delaying my journey to financial freedom." The second lens is even more powerful. Below that, write down the likely impact of this decision on your heirs, whether that means your children, your grandchildren, or a cause you care about. This forces you to zoom out even further, to think not just about your own life, but about the legacy you are building. The act of selling the stock in a panic is no longer just about stopping your own discomfort. It's about potentially diminishing the opportunities available to the next generation. Suddenly, the short-term emotional driver of the decision, the fear or the desire for immediate gratification, is pitted against the long-term, tangible well-being of the people and things you care about most. The generational ledger is a mental tool for defeating hyperbolic discounting. It forces you to give weight to the future. It transforms you from a short-term speculator in your own life into a long-term, executive decision-maker, aligning your present actions with your deepest, multi-decade goals of building lasting wealth and achieving true financial independence. To fully grasp the power of this arbitrage, we must look at its antithesis, the world in which the other 99% of market participants live. This is the world governed by the tyranny of the quarterly report. For most publicly traded companies and the investors who follow them, the world resets every 90 days. The entire rhythm of business life is dictated by this cycle. In the weeks leading up to the quarterly earnings announcement, a palpable tension builds. Analysts publish their estimates for revenue and earnings per share. The company's management team, knowing their bonuses and the company's stock price hang in the balance, will often go to extraordinary lengths to meet or slightly beat these arbitrary targets. This can lead to value-destroying behavior. A company might offer deep discounts to its customers to pull sales from the next quarter into the current one, just to make the numbers look good. This boosts current revenue but hurts long-term profitability. As we mentioned, they might slash the budget for vital long-term projects like research or employee training, because those are expenses in the short run, even though they are the seeds of future growth. They are, in essence, selling the company's future for a slightly better present. When the earnings are finally released, the market's reaction is often wildly disproportionate. If a company beats its earnings estimate by a single cent, the stock might soar. If it misses by a cent, the stock can be crushed, even if the long-term prospects of the business are completely unchanged. This entire system creates a volatile and myopic environment where true, patient value creation is often ignored or even punished. CEOs who make smart, long-term investments that won't pay off for several years might see their stock price lag, putting them at risk of being fired or facing an activist investor who demands short-term results. This is the insane, short-sighted world that Warren Buffett is competing against. He is an Olympic swimmer competing against people who are only allowed to hold their breath for 10 seconds. Their structural limitation, their obsession with the next quarter, is his greatest opportunity. He can buy wonderful businesses from them at a discount, simply because those businesses are going through a temporary rough patch that makes their next few quarterly reports look ugly. He is playing a different game on a different field with a different clock, and that is why he almost always wins. The final, direct financial connection that brings this all together is the mechanism that makes Berkshire Hathaway the ultimate time arbitrage machine, its unique access to permanent capital and float. This is the financial supercharger that powers Buffett's long-term strategy. The core of this advantage comes from Berkshire's massive insurance operations, companies like Geico. Here's how it works, explained simply. You and millions of other people pay your Geico car insurance premiums up front. You pay today for coverage that will last for the next 6 or 12 months. Geico collects all this money, billions and billions of dollars. But it doesn't have to pay it all out immediately. Accidents happen over time. This pool of money, the premiums that have been collected but not yet paid out in claims, is called insurance float. And here is the magic. Legally, that float belongs to Berkshire Hathaway. Buffett gets to invest it for Berkshire's benefit. In essence, Berkshire's millions of insurance customers are lending the company an enormous amount of money, and not only do they not charge him any interest on this loan, but if the insurance businesses are run well, they also generate an underwriting profit. This means the cost of this capital is often less than zero. He is being paid to hold and invest other people's money. This float is the ultimate form of permanent capital. It is stable, it is long-term, and it is incredibly cheap. It provides Buffett with a massive, reliable war chest that he can deploy when opportunities arise, like during a market panic. While other investors are selling to meet redemptions, Buffett is armed with billions in float, ready to buy. This structural advantage, born from the patient, long-term business of insurance, is the ultimate financial manifestation of his time horizon arbitrage. It allows him to think in decades because he has capital that will be with him for decades. It is the perfect marriage of a long-term investment philosophy with a corporate structure that is uniquely designed to support it. It is the final piece of the puzzle, the financial engine that connects his patient temperament directly to the unparalleled success on his company's balance sheet, creating a compounding machine unlike any the world has ever seen. You have just been given the blueprint to the most powerful, yet most overlooked force in the universe of finance. You've seen that the path to extraordinary wealth is not paved with clever trades or speculative gambles, but with the relentless and uninterrupted application of time to quality assets. You have moved beyond the simple formula and have begun to internalize the counterintuitive, exponential logic of compounding. You have seen the psychological armor required to protect this process from our own worst enemies: fear, greed, and impatience. You now hold the checklist to identify the true compounding machines and the discipline to avoid the siren song of the story stock. You understand that in the world of investing, inactivity is often the most profitable action, and a long-term time horizon is the ultimate competitive advantage. You have acquired a powerful mental tool. But understanding the engine of compounding is only the first step. An engine, no matter how powerful, is useless without a chassis, a steering wheel, and a skilled driver. Warren Buffett's system isn't just one idea. It's a latticework of interconnected mental models. You now hold the key to the power source, but how do you steer it? How do you value a business to ensure you are buying it at a fair price? How do you build a portfolio that can withstand the inevitable crashes the world will throw at you? How do you develop the critical concept of a margin of safety? You have mastered a single crucial piece of the architecture of wealth. The video that is now on your screen is the next part of that machine. It is not a random suggestion. It is the piece that connects the engine of compounding to the psychology of market madness. It is the bridge between understanding what makes a great business and knowing what makes a great investment. It is the link that transforms this raw power you've just learned about into an unshakable, lifelong strategy. Many will stop here, satisfied with this one piece of the puzzle. They will feel a fleeting sense of enlightenment and then return to their old habits. But those who are truly serious about achieving financial independence, those who see this not as entertainment but as essential financial education, will understand that this journey is not over. The choice to click is not about watching another video. It is a decision to continue building your mental arsenal. It is the next step in your ascent. Complete the map.